Since their peak in August 2022, UK house prices have fallen 5%. But the big question is how much more will they fall in the next 12 months? Expert predictions range from a modest 2% decline to a fall of 12% from Capital Economics. Why has the market turned so quickly? And could the house price correction be even worse than forecasts predict? Sweden is a good example of how quickly a housing market can turn. They don't even have a big buy-to-let market, but since interest rates started to rise last year, house prices in Sweden have fallen 20%. Since 1981, there was a prolonged boom in Swedish house prices. Low interest rates and poor asset returns encourage people to put money in housing. But when interest rates rise, the economics of buying suddenly changes. And this will be a global phenomenon for 2023. Canada is predicted one of the biggest falls of 30%, with the UK, by contrast, is slightly more moderate. Now, rising interest rates is the main factor behind the pessimistic predictions for the UK market. Mortgage rates have soared from under 2% to nearly 6% in just a few months. For a £200,000 loan, this increases the interest rate cost from £4,600 to £12,000. Or from another perspective, the amount a typical borrower can get has fallen 35%, which is going to reduce the number of buyers and potential demand quite significantly. Now, at this point, someone of an older generation may be keen to say, well, I remember the day when interest rates were 15%. There's nothing to read about 6%. Now, this is true, but only part of the story. House prices are simply much more expensive. In 1991, average prices were $55,000 compared to $265,000 today. To put it into perspective, the average UK deposit for first-time buyers is now $60,000, more than average prices in 1991. This graph shows that because of higher prices, a 6% interest rate today is the equivalent of around 13% in 1989. The key metric is how affordable mortgage payments are. And you can see that as a share of take-home pay, mortgage payments have risen from 28% to 40%, and it could go even higher through 2023. And at this kind of mortgage payment, many would-be buyers just can't afford it. Even though renting is expensive, rising interest rates makes it relatively cheaper than a mortgage for the first time in many years. Now, it is worth pointing out that the UK housing market is highly regional. You can see that the share of mortgage payments varies from 24% of income in Scotland and the north of England to 67% in London. And this, of course, makes London prices much more vulnerable to falls than in the north. But still, all areas will see rising costs this year. Another warning sign for the UK housing market is the ratio of house prices to income ratios. The nationwide index reached a record last summer of 7 times earnings, higher than the financial crash of 2008. The ONS measure gives a ratio closer to 9 times earning. A combination of rising prices, falling real wages, all increase the overvaluation of UK housing. Now, at this point, some might argue that the fundamental shortage of housing in the UK means that we are not going to see a big fall, or very little. The argument goes that although housing is mostly unaffordable for young people, they have been squeezed out of the market by older, wealthier people anyway. Home ownership rates for the young have already fallen. However, whilst lack of supply is definitely important in the long term, it would be a mistake to place too much emphasis on this, at least in the short term. And this is because the housing market needs new buyers. If potential new buyers are not able to afford, then prices will fall. The fact many old people own a house outright won't prop up house prices on their own. What counts is new demand. Another factor putting downward pressure on prices in 2023 is expectations. Since people widely expect prices to fall, who is going to want to pay the full asking price? Buy-to-let investors, a very important player in the housing market, are now seeing gross yields fall and the cost of their mortgages rise. Why would investors want to buy in a time of falling prices and falling yields? On the theme of investment, the housing market has done very well in the last 15 years because the real rate of return on other investments has been so poor. If bond yields are close to 1%, buy-to-let with yields of 4 to 5% look much better, so a lot of money has been going into housing. Julian Jessup of the Daily Telegraph recently reported how the Bank of England's own analysis suggests a 1% increase on index-linked yields could lower the equilibrium level of real house prices by as much as 20%. Now this is because if interest rates remain high, investors will find new investment opportunities away from the housing market. So this could fundamentally reduce demand for housing, especially amongst buy-to-let investors. And if this occurs, you could see bigger falls in prices than many expect. A key factor behind this analysis is how much will interest rates rise, and will they stay above 3-4% for a long time? A lot depends on inflation. The Bank of England are actually forecasting inflation will fall in 2023. And if this does occur, it will be good news for home buyers because the bank may be able to limit interest rate increases, possibly even cut them towards the end of the year. However, we should bear in mind, forecasts on inflation have often been over-optimistic. Just yesterday, data on wage growth showed average wages in the UK rising 6.5%, even higher in the private sector. This suggests underlying inflation would take time to fall, and this could increase upward pressure on interest rates. What about the very long term? Is housing still a good investment? Well, I would always say yes, especially if you plan to live in it. Housing is a good investment, especially when the expected rise in the number of householders is significantly faster than the growth in supply. Recently, the government backtracked on legal targets for councils to build houses. This means in areas where houses are most needed, they won't be built. And the UK's chronic shortage of supply shows no sign of abating. A Labour government of 2024 may be more likely to be pro-house building, but governments of any stripes rarely meet their own targets. Now, having been mostly pessimistic about house prices in this video, there are two factors which are important to be aware of and which may moderate price falls. Firstly, if we look at real house prices, which is adjusted for inflation, there is less of a red flag. Real house prices are actually £55,000 less than they were in 2007. And this shows that a lot of the recent rise in house prices is a reflection of inflation in the economy. It also means that the rise in house price to income ratios are largely a reflection of a very poor wage growth we have seen in the UK. Also, what about current homeowners? How will they be affected by rising interest rates? Well, it will certainly be a shock, and I'm not looking forward to my 2-year fixed deal ending this summer. It could cause a rise in arrears when interest rates rise so much. But some things are different to 1991 and 2007. Banks are now strongly encouraged to avoid repossession. In periods of distress, you can easily switch to an interest-only mortgage for a temporary period. Also, despite the grim economic outlook in the UK, there is one piece of good news, and that is that unemployment is near historic levels, which is really unprecedented given the UK's entering into a recession. So it is very hard to see a rise to unemployment to the rates of 10% that we saw back in 1991 or 2007. It may rise something, but not to those kind of levels. Therefore, although new buyers will be thin on the ground, it's unlikely we will see a surge in selling from homeowners who can't afford to pay because they're unemployed. Therefore, for this reason, it's unlikely we will see a 30% crash like back in 1991. So there are definitely conflicting forces in the UK housing market. On the one hand, you have this fundamental shortage of supply, which is keeping prices expensive and which will moderate any house price crash. Yet at the same time, house prices are genuinely overvalued, and buyers this year will really struggle with higher mortgage payments. We've got used to these ultra low interest rates, which has not distorted not just the housing market, but many other asset markets too. And it's a very interesting argument that if interest rates remain elevated for a considerable time, you could say a return to normal, it may well encourage investors to look beyond the housing market, and this could reduce equilibrium prices by more than some expect. I hope you found this video useful. If you do, please give it a thumbs up. If you have any questions, feel free to leave a comment, and I do hope to make more videos on the housing market soon.